Hey everyone, it's Imran back with another episode of Trader Chats. It's been a while since I did one of these, but due to popular demand, guess who I've got back with me? I've got the one and only Cem Karsan. How are you doing, sir?
Good, man. Good to be back. Yeah, our last one was an awesome conversation. Excited to dive in again.
Yeah, we went a bit viral on Twitter. People were loving the conversation. I think it was December last year we spoke, so it's been a while, nearly a year on. Quite a lot going on in markets. But last time we discussed things like structural hedging flows that you talk a lot about, creating tailwinds for markets as those hedges decay away, all of that massive index vol supply in structured products, how that was feeding into extremely low levels of implied correlation and actually creating dispersion amongst all the single stocks. And we saw that particularly hit a crescendo in the summer. And then also the increase of zero DTE optionality being 50% of the market and whether that created some systemic risks. So those were some of the topics we touched on last time. And I'd love to get obviously an update on those topics and where you see that now in terms of a year on from that conversation. But I think the elephant in the room is what has just happened in the US election, where we've had Trump is well and truly back with a landslide victory. We had some enormous moves in asset prices in the last 24, 48 hours. I mean, what does that mean for you in terms of your outlook for markets, the fact that Trump came in so convincingly, and maybe also your outlook for volatility?
Yeah. So going into the election, before the election, I was actually out at SIBO's Risk Management Conference, and we partnered with the SIBO to actually do conversations with kind of professionals in the options and vol space across the space. It is actually an incredibly diverse space, increasingly so every year. And we got some really good insights about the election and how things were structured from different people, big trends that are happening in the space. So we're going to continue. We've decided to have those conversations once a month going forward. We're going to do that from the SIBO floor, which will be really exciting. So people should tune in for that.
Nice.
But some of those insights that I can kind of speak to a little bit now, and now that actually we know the net result, also kind of speak to that. For one, I think it's important to note some of the big things that are happening in options and vol-in are that some people aren't fully appreciating is how much growth there's been in the structured product and related space. In the last 2 years, the stats are we've seen structured product issuance, annual structured product issuance go from about 500 billion globally to about $1 trillion. So it's doubled in size in the last 2 years. The ETF space, that is essentially structured product type, option positioning in an ETF wrapper in the last 2 years has grown 700%. It's gone from 25 billion to 175 billion.
Wow.
And it's growing exponentially. These are just a couple of things. Never mind mutual funds and all kinds of other, kinds of structures we could dive into that are outside of that purview. I'm not just saying that to talk about, hey, options are big, they're new, everybody's doing it. That structured positioning is having dramatic effects on the underlying, not just options and vol space, but the underlying market writ large, right?
Is it all index vol selling again, as we're used to seeing?
Not all of it, but a lot of it, yes.
A lot. That's the predominant flow.
That is the predominant flow, but again, there are others, and some of them are contrary to the other flows, which create opportunities and dislocations. That growth has played a huge role in this end of the year, more than any other year. Again, a lot of those structured products, majority, are tied to the end of the year. Many of them to a December 20th expiration, some to the December 31st OPEX. And to put it in context, like those are big numbers, a 500 billion annual increase in 2 years in structured product. The average volume that determines where the underlying S&P 500 goes is somewhere between 75 and 150 billion per day. That's the incremental volume that pushes the market. So when you see the market up 1%, and that 1%, by the way, is a $500 billion appreciation in the underlying value of the S&P 500. The stocks.
It didn't take 500 billion to move it. Basically,
it took essentially 1/10 of that number, right? Maybe a little bit more. So it is really, really important to understand how big $500 billion is per year in the context of that, right? These are massive flows. People have talked about the JP Morgan trade, right? The hedged
every
equity,
quarter,
right?
people
talk about that trade's $20 billion.
20 billion. That's right. Yeah.
It's not like it's tiny compared to the underlying market, but the flows are significant. Like a big percentage when it comes around relative to the actual daily flows or what happens. It matters. Now, I think it does get a bit over exaggerated, but that said, like, $500 billion is a dramatic amount per year.
That supply of vol. Do you think that's the reason why, we went into this election with implied move at around just over 2% on the S&P, with VIX kind of just above 20. If we look back at past elections, I remember the 2020 election, and we had obviously had COVID that year. The 2020 election, we went in at a VIX of 35. So would you say that had a part to play as well in that vol supply meant it was hard for VIX to actually go into that election in the 30s, basically?
That's definitely part of it. I think the important part to note is that vol is just structurally lower, right? Across, it was less. The event vol actually was quite high
because the realized was nothing, right? Right. That's right.
Not just the realized, the other vol outside of that election, right? Like if you just take that one day slice, like the event vol itself, like it was actually historically high. But the actual overwhelming vol, the level across all the other days, significantly lower than we've been seeing, and that is that itself is a function of vol supply. Now, important to note, I think a lot of people don't really appreciate this. That vol supply has increased skew dramatically and increased the supply and demand imbalance, right? That exists in the market, right? So that's regardless of whether it's selling vol or buying vol, the skew dynamics are really, really significant to these trades. What we saw is concentrated at the end of the year, a massive short interest for dealers on the put side relative to the call.
So the structured products are buyers of downside, are they?
There's more buying than selling on the downside, net, and there's massive selling on the upside. So
massive upside selling. Okay, that's
so the net effect, it is significant. And then on top of that, you have all of the hedgers, right, and all the people that are actively managing portfolios at the end of the year, which has also increased outside of structured product land. And then you're talking about a December expiration that's been on the books for several years, right? And then it's behind an election that has an event vol, which then makes it hard to get supply in front of December. You have, not to mention a significant potential different set of policies and alternatives that was essentially making it so that the supply of people willing to hold this in the line are less willing to put what they perceive as risk to hold it. But the imbalance, the increase in demand relative to the ability for the market to manage and control and people to warehouse that risk at the prices at that scale was significantly diminished. Whereas that was the case even going through the summer and early this year. What you saw in August actually was to a large extent. I
was going to ask you about August.
What happened in August net is that skew, which had been in the front of the curve very low, and in the back kind of average. What happened when we had that big move? Everybody had the summer August vol. This was not a vol-centric event, despite what you saw in terms of it didn't cause the decline. It really what happened. The primary cause of the move in August was a function of the yen carry trade more than anything that forced that move at that time. But once we moved to American markets, gamma was very well supplied. Skew was very well supplied on an overall basis in the August expiration. The problem is September, October, November, December, particularly December, and all that structured product issuance back there was dramatically out of whack. And what we saw is a 4 sigma move in Vega and skew in the back relative to the front. We saw an incredible dislocation, something we've never seen, right, at that scale. Again, it sounds like a nuance because we're not talking skew overall. We're not talking vol overall. We're talking about this twist, like a skew swap.
The skew curve, basically.
Yeah.
Just saying longer dated skew, like medium term skew went nuts relative to front end skew. Is what we're saying.
Correct. So December, November, January skew exploded higher.
Okay.
The front did participate, but not nearly as much.
And it reverted faster as well.
And then as we rallied, the skew in the front collapsed because people were long it against everything else, right? And the skew in the back not only stayed higher, but actually went higher. So there were all kinds of relative value trades and pods. I know of some at Millennium and a couple other places that were blown out, right? Like kind of washed out to sea. And again, little nuanced types of trades that have worked very well for a long time. There's lots of banks that had to write down, hundreds of millions of dollars on these trades as well. And the supply that has been there historically, to manage these types of things just was taken off the table.
So I thought I was under the impression that, well, first of all, I'd like to know was there any telltale signs that blow up in August as it was happening or just before it was happening? Did you get any telltale signs? Or was that kind of a bit of a freak move that just happened quickly and it was just like, okay, wow? Because I didn't see it coming, I'll be honest.
So to be clear, we were very vocal that going into May, right, that the summer was going to be this incredible vol crush. And that on a realized basis, the market would be pinned. We call it the summer of George, right? In May, June, July, until August, basically 3.5 months, we didn't have a decline of greater than 3% and realized volatility got decimated and vol supply was, at a record. We were also very clear in May that this would probably end in early September, right? And that there would be some significant vol event in the fall as a result of like the over extension on vol, and given the election in December and the positioning that we saw back there, those were the clues, right? That we would see something at the end of it. And that
it came a bit earlier. It came a bit earlier.
Like the wobble, right? Like the wobble would come. And we told people in July, that it was time to start buying vol. It was not time to start selling the market. It was not time to start, but like long dated vol was too cheap given what was likely coming. So we were, these were all, the signs were there, right? Now the timing, it came early. It came a month early.
Came a bit,
and we were right about the vol, and the vol started going up, and but the decline and the speed of the move was earlier than expected. And again, I want to be clear: the reason that we thought it would last till September again is because of the supply of skew and vol in the front of the curve. There was still a dramatic amount of vol and skew supply in the S&P, and normally the way that plays out is you have to kind of squeeze out that vol. You get a continued push higher. They bleed it out, basically make it the trade as hard as possible. And then you get kind of quick reversals while vol has been increasing. And that's the most likely path. Like there's always a billion other paths. Everything rhymed and made sense. The difference is, the yen carry trade, the parts that kind of that were tangentially tied to this world. Not to mention people realizing that vol was going higher, that there wasn't an easy way to hedge once stuff started to unwind. And so again, these things can come a little bit early. They generally, the point is that the skew was very poorly supplied in the back of the curve. It was over leveraged relative to the potential market's ability to digest it. And once the supply was bled out in the front, right, it was I don't want to say inevitable, but highly likely you were going to get some issue. The thing is, it happened while there were hedges in the front, which was better. I actually think this would have been a way worse situation, right?
Mm.
If it had happened in September, if we had gone higher and then all of this had unraveled in September, would have been, people would not have had the hedges and ability to control this. I mean, it could have been a 20% plus decline.
Right. Yeah, well, they did revert pretty, like the vol reverted quickly. I mean, I expected the skew to persist for a while because of the election, and also because I thought the VAR models, all the risk managers would have seen this massive VIX spike in their VAR models. And so that would then be, they'd tap their portfolio managers on the shoulder and say, you're not allowed to run that much VAR risk, because now for the same size position, you have to shrink your position because the 2-year look back includes this monster move, right? So the skew is naturally going to be less supplied going forward after that August spike, and it's probably going to be that way for a while now. But the speed at which the front end vol got slammed back down, that was impressive.
Because it was, but that's the thing I could have told you, right? If we got that decline, it was almost inevitable that you got this massive skew swap, because there was tons of coverage, right? People were actually net long skew, net long gamma.
They're along the front end,
but they're along the August and short, SEPOC, particularly DSJAN, right? SEPOC Nov DSJAN, and so, that once the move happening was much more likely because there was a clear imbalance of supply and demand in the back that represented a risk. But the key was what you couldn't have happen was the front end, which affects realized vol, right? The gamma is ultimately, going to hedge you at some point if you get a crash, right? That had to underperform. And so the path was exactly what, once we got that decline, was much more likely to be that kind of a path, which was quick reversion, skew collapse in the front, because it was well supplied and everybody's trying to monetize and sell that to get back what they're hurting on, which is Vega. And ultimately that stuff just exploded higher. And that's why we saw, again, even though a reversion, once August came off the board, a little bit of a scale back in September, right? Because skew was starting to go higher in the back of the curve and people were unhedged. But again, at that point, you had plenty of covering, de-risking all of the other risks, right? The carry trade and everything had been unwound, and it was a much better kind of environment, but with people mindful of the risk to rally from there. But again, the skew itself remained incredibly high up until the election because of that. Now,
yeah, and this super high skew going into the election, do you think this has played a large part in the Vanna impact as the vols got crunched because the skew was coming from such a high place? The Vanna rally is just like that much more powerful.
This is why we've been so confident of this rally happening, no matter what, and into the end of the year. It's not over yet.
It's not what I was going to say. Like, super strong year-end seasonality anyway. We've had this Vanna buyback. We've got the Fed cutting rates. They just cut rates 25. I don't know what they're saying in the presser. The charm flows, the Vanna flows are all there. Do you see anything? Is there anything out there that you can see that could derail this year-end rally? Because that's what we're all dying to know.
Yeah, the probability is not inevitability, right? You have to understand that we don't live in a two-dimensional world. A nuclear bomb could go off in New York tomorrow and we'll be down not just 15%, we'll be down 30% because the tail is fat. Right? Like, you can't have that kind of, right. I'm just, the reality is, like, the positioning is fat left tail, right distributed. That's what this positioning means on its own, without all the other flows and other things going. And you have to understand that this is not just because pricing was high and skew was high, which meant it had a long way to come down. The size that's leading to that higher pricing and that imbalance was also dramatic, as I mentioned.
That's an indication. Like, when it's that pumped, it's because there's been so much buying of it, basically.
But they both are important inputs, right? To Vanna and Charm, right? It's not just the pricing in the higher deltas, which mean the deltas have more potential energy to buy back, but it's the sheer scale and amount that dealers have to warehouse and then to buy back.
That's right.
And so those combined are dramatic input. Now, on top of that, right, which I think is an important, now we've talked about the flows, right? You had an event vol and you had all of the positioning there, which we've now seen kind of push through the market, and that's been handled, but there's still, and by the way, December January skew, which was really high, has come down dramatically, because that was not only, part of the reason that the supply wasn't coming in was not just because of the blowout in August and the massive demand, but it was also like people weren't willing to take even those incredibly high levels and try and monetize it because there was fear of a contested election. And at least that's the perception. Now that that's off the table and things are done, now people are willing to come in and take that risk. Now the supply and demand is still significant there. The size is big. That skew is still relatively high, especially relative to the front of the curve. Again, the front of the curve is soft in terms of skew now that all this has come out because, again, everybody's owned that. Now they're trying to get back what they are short. But that there's still a supply and demand imbalance back there. Now, for the most part, the risks and a lot of the things that are really critical, other than the supply and demand, right, are meaning that people are stepping into the fray and trying to take a good risk reward on that stuff now.
I imagine the appetite to sell risk premium is going to increase now the election's out of the way, and people have got some.
This is the seasonality that we've been talking. I mean, that's not a surprise, right? This is kind of why we had confidence that this was that wobbled, which would be decent in September, and scary would be a time to buy, and that once this election came out, things would accelerate, and that we're likely to see this into the end of the year and into early January. Now to be clear, there is another important point which I talk about in other places, which I want to put front and center. These wand and charm flows paired with, if there's any other edges that are positive flows. These are not the only flows in the universe, right? There's actually other ones that are as big, if not bigger. And one of them is the end of year releveraging effect, which I've talked about a decent amount. It's not an options based thing. This is a simple fact that as the market goes up, right, there is more collateral, which then causes releveraging. The majority of money, people don't think about this the right way when they think about stock land and bond land, right, in asset world. They think, oh, well, I own something. It goes from a value of $10,000 to $20,000. That doesn't mean I'm going to buy more stuff because the value of my stuff went up. The majority of money is leverage. The majority of if you look at monetary supply, it's not actual dollars that are being printed. It is money that is being lent or borrowed in our system.
By the banks,
By the banks. And then by extension, by people and by corporations primarily, right? And at the end of the day, that money is, as the value of underlying assets go up, entities can borrow more money. They can not just borrow more money. They, as a hedge fund manager, if I have leverage in the portfolio, right? If I go from $100 million portfolio to $120 million portfolio, guess what? The size of my positions need to increase by 20% in order to scale the portfolio. That is true for banks. That is true for corporations. That is even true for individuals, even if they don't think about it, right? When I bought my house, several years ago, I didn't go actually put money. I just put my collateral up. Well, at Morgan Stanley, I have, among other places, I have a bunch of assets. So I just said, hey, just collateralize that. I want a loan for the whole thing at 2.5%, right? Like at that rate, like I don't need to actually put money in, commandeered here. I have assets, whether they're T-bills or whatever, you can use those as collateral. And so your ability to get leverage increases with increase in your collateral. And it's a very simple idea that most people don't understand. So when the market goes up, by 20%, the U.S. equity market is $50 trillion. The global equity market's $50 trillion. That's $100 trillion are more or less tied to one another, not to mention another $100 trillion of other things that are tied, whether it's private equity or other things that are tied to U.S. equity valuations in some form or another, $200 trillion. It goes up by 20%. That's $40 trillion of new collateral. Like we talk about money supply and who's increasing what liquidity. The greatest producer of liquidity on the planet is the market itself. It's assets themselves. So the momentum machine is huge. And again, $40 trillion in the context, we were just talking about 500 billion being a lot, right? On the structured product side. Now, not all of that gets reinvested on January 1st. Some of it comes in every day or every hour as like values go up, people have more collateral, and there's high frequency kind of moves in this data. But a lot of it comes in monthly. That's why end of month, beginning of month on a calendar basis, right? And any month, the best performing historical days of the 30 days, right, of the 21 days of each month. It's not a coincidence because there's pause, like markets tend to be up, tends to be more money, and there tends to be a reinvestment effect. Quarters are even more positive. And guess which one is the biggest quarter of all? January 1st, December 31st. Exactly. So Jan 1, when the market is always, by the way, there's new money being created, but when things go up and there's a big up year, those numbers even get more skewed positive. So it's not a coincidence. People talk about Santa Claus and magical constructs, like and the January effect. They call it just these magical things. There's a reason those 4 weeks, from the last 2 weeks of December, the first 2 weeks of January, that's 1/12. It's a month of the year, dramatically outperform any other 4-week period in a year. You look at 120 years of history, the winning rate is like 81% with a 1.2. I mean, I don't know the exact numbers, but over 1% returns over that month. It's about 1.2 or 1.3. I mean, these are incredibly positive, details over the course of a long period of time. That's not a coincidence. That's not magic. It's flows. And those flows, again, particularly strong when the market is up. Market's up 20%. That's a big deal. So add those now to the Vana charm. Yeah. Well, I mean, now there's like get out of the way. And it becomes a self-fulfilling prophecy because then there's a chase. And then, the whole thing kind of feeds on itself. So
it's fair to say you are bullish. Okay. Now, what I want to know, though, is other than Delta, what other sort of trade you've mentioned in the past that there's some value in terms of vol trading, right? There's some value in owning the medium-term upside part of the surface. Okay. Because you have steep skews in the longer end of the curve. You have low levels of absolute at the money vol, and then therefore that upside vol is trading really cheap. And if you own like 6-month vol Delta hedged, then you're owning it at a very low vol, right? So that can work on the way down in the market. That can work on the way up in the market, right? But the one scenario where that doesn't work is where you get a really slow grind up in the market, basically, right?
Yeah, I think everybody wants it to be very simple. Everybody just wants a simple, hey, tell me the one thing to buy that's going to make me a lot of money. Guess what? It's not that simple.
Yeah. So what do you do about that scenario where, let's say we like that trade. Let's say we can own upside vol at like 10 vol or pretty close to 10 vol. Okay. And it's not super short dated. It's not decaying like crazy, but we own that vol. And the one scenario is the market drips up 20 bips a day, and vol does continue to bleed lower. Is there like a zero DTE gamma selling strategy that is there kind of a way you mitigate that risk if you own that position where you kind of do short dated stuff that actually does okay in that grind up scenario? Like, how do you feel about that? Because there's clearly people out there doing zero DTE stuff that like I don't know, you're a market maker, right? So those big massive condors that keep trading, right, in the short date 1 DTE stuff, right? What are your thoughts around those sort of flows?
So first of all, there's never one strategy that just works all the time. I don't want this to be like some overarching, like the trade is to go by medium-term calls and, just hedge them, whatever. Like there's a higher probability of that working because the vol is low. And the vol is low because there's lots of structured sellers of that stuff, right? Yeah. Which allows for this kind of carry trade. Carry trades work. Like there's a carry trade in the S&P 500. It's one of the biggest in the world and bigger probably than the yen dollar carry trade. It is skew, right? And skew is an edge.
Yeah.
That's simple. You got to manage it, and it doesn't work in every environment, and there's a tail to it, right? Like you got to understand that. But that's the truth. Now, when you take that edge in something like, and there are other structural reasons, which again, we have yet to talk macro, right? We've been talking flows. Yeah. There are other structural reasons to believe, right, that upside volatility is more likely or more probable, right? Mm-hmm. You pair that with this trade with edge, and now you have a real great opportunity. And that's where we are now, right? That's where we've been in this broad cycle, right? Mm-hmm. Now, that doesn't mean it's something that's going to win in every scenario. And there are, you're buying convexity, particularly to the upside, but convexity writ large for very cheap. And in order to increase your risk-adjusted returns, that may be a good risk-adjusted return on its own. But to really make a good risk-adjusted return, you go find where it's expensive, right? And you try and net stay long, right? But
stay long vol, but fund. Yeah, exactly. You've got to find a funding leg because that's the carry. That's the carry that you're bleeding, right?
And that's what you're asking, right? And so to kind of dive in, there's a lot of different ways we can fund it. It depends on several, where are we, daily, weekly, monthly? I would caution against just blindly structuring a trade and then sitting in it for 3-6 months, right? Like I would more say, to your point, like actively manage, selling things that are more expensive, that are shorter dated, right? On the more skew put side of the curve, probably, but also, places where it's the probability is very low, and it can help kind of fund these calls. Also, I would say, if you're buying this stuff in the index, there's places in the market that you can look at from a more broader term perspective, where supply might be, dynamics might be in place that you can have a higher probability of selling the vol at a premium. So yes, I think that's the approach. I'm not going to go tell you exactly what to sell.
But zero DTEs. I'm still going to press you on the zero DTE question. What you're
zero DTE has a lot of structural edge to it. It is not for the faint of heart. I'm not going to come in. This is not investment advice.
For sure, it's not.
Yeah, but particularly if you want a little croissant crumb, selling calls, or vol writ large, overnight. Starting after the close into the morning, there is a significantly higher premium in zero DTE than the next day. And you tend to realize a bigger relative value edge on selling overnight and then buying back during the day. And part of that is a flows based, margin based issue. A lot of the sellers of vol that do appear, and the liquidity that counteracts things that happens in the U.S. trading hours after the open. And so if you are willing to manage overnight risk in the zero DTE world, that's an actually particularly interesting trade. Yeah. That's not the only. Again, there's lots of other trades that I could pair with that and talk about. But that is the lean in the place where there's structural edge on the curve on a calendar basis that I think is appealing and interesting.
Because something the whole world is like mad for nowadays is gamma positioning, right? Like there's millions of companies out there that are trying to decipher what the real-time gamma positioning is in the market, whether it's on indices, whether it's on stocks, and they're trying to use that as a predictive measure for where we might go. Because the claim is that large pockets of gamma tend to be tested, basically, right? So if there's certain strikes where there's a lot of gamma positioning, people are saying, well, that area is kind of the gravity that's going to be tested. So I'm going to then position myself for the market to go towards that gravity, and that is giving me some predictive edge. How do you feel about that predictive edge? Do you think that's a real phenomenon? And if it is, why does that exist?
In the movie Blades of Glory, starring Will Ferrell, they said that no one knows what it means, but it's provocative. The reality is gamma is convex. It's provocative. People really get excited.
They love it.
Gamma.
They love it.
They love gamma. They love gamma. Everybody loves gamma. That's how the options world, because it's the gamma squeeze can lead to big numbers and exciting. It's like lottery tickets, right? Gamma is important. I'm not saying it's not important. It's just part of, it's a measure of part of the flows that come off of these things, and it's a measure of some of the reflexive kind of dealer positioning. But it is the part that is tied to one dimension, which is the underlying market move, and maybe less sexy is Vana and Charm. Among others, right? But those are different dimensions. That's time, and the passage of time. And it's, the move of vega and vol, which are those two things combined, are very related. The reason I think those are things that people are, again, people have a confusing view of time. They think of the stocks in two dimensions. Things go up or down, right? They don't think about how things move through time, unless you're an options person, or what vol or vega or implied vol mean. That's more confusing to your average person. So gamma is sexier, but these things are more predictable because we know time moves in a certain general way. Vol has a tendency to do certain things, so they're much more predictable and much more valuable for determining flows and direction. You can measure them, you can predict them with much greater accuracy. Gamma is fickle, particularly in a zero DTE world.
Yeah.
And the effects on whether gamma works or doesn't work are generally much more tied to all the other flows that I've mentioned as well. If I can't tell you the amount of times that short gamma exists in a portfolio, but structured other flows from Vaughn and Charm lead to massive supportive positive flows, mean that the trade just doesn't go anywhere. So you really need to understand all of these dynamics as it relates to options. And gamma is the sexy one that everybody is focused on, but I actually think the other ones are more predictable, and because they're more predictable and consistent, they're more likely to be important on a daily basis. Not to mention, they give you a real edge to lean against maybe some of the other things like gamma and other things that you can. So
what I'm hearing from what you're saying is that the nature of those other second order Greeks gives you more of a directional tilt on where we may go, right? So I don't think gamma, and I agree with that. I don't think gammas are very good. I don't think like looking at where the max gamma points are is good at predicting that we're going to go there. But if we do go there for whatever reason, if there's a large enough concentration of gamma in comparison to the regular flow of that underlying asset, then there's a good chance we're going to stick around those strike levels, basically. So we don't know that we're going to go to those strike levels.
That's true.
When we go, we're likely to stick around there if the gamma's big enough. That's kind of how I look at it.
Yeah, I think that's definitely true. Definitely one of the important things to be considering. But again, they all interact with one another, and this is part of the puzzle. It is not the when you say options, almost the first thing people focus on writ large is gamma, and I just I'm here to tell you that it is one of a number of equally important, if not more important, other flows that interact together. And if you're only looking at gamma, you're missing. It only tells you so much.
Sure. Well, I want to talk a little bit, change direction a little bit, talk about macro. So obviously Trump's in, people are getting a bit worried about higher inflation down the line. Well, certainly the bond market is. We had a decent sell-off in the bond market, although it's bouncing today. Do you think this kind of new world that we're going to head into with Trump leads to higher inflation, higher interest rate vol? And if so, what does that mean for equity vol? Does that lead to more equity vol, or is it more a case of we go to that dispersion world where rates are winging around like crazy, but some stocks love it and some stocks hate it?
If you've been following me for 4 years, you'll know that we talked about inflation in being secular, and that from the very beginning. And at transitory 1.0, we said, not so fast. At transitory 2.0, we said, not so fast by the dip on yields. On transitory 3.0, we said the same thing. And so here we are, right? Like this is a structural trade that it's not a straight line, right? If you look at 1965 to 1982, right? The graph on inflation looks like the following: interest rates, inflation and interest rates broadly, as a proxy too, started at around 2%, and then worked its way to 7% in 1966, 67. It then declined amidst a recession into 19 sorry, not a recession, into 1968, 1969, it declined again. And then as the Federal Reserve turned and started stimulating again, lowering interest rates, I'm familiar. What happened? Inflation went to 11%. Mm-hmm. And that drove a significant recession, mild but long, 69 to 70, 71. Mm-hmm. Which amidst a cyclical recession, we saw that inflation and Fed funds rate come down to 4% or so. This was the second kind of tier inflationary cycle, and people were like, "Oh, we're done." Fed said, "We managed to bring inflation. We vanquished inflation." But again, that lowering of interest rates eventually drove the long end of the curve and inflation to then 14%. And then they had a deep recession again, much worse than the one before, 73 to 75. Mm-hmm. And that recession was way more painful because inflation interest rates only came down to 6, because the Fed was stuck in a box. They couldn't. They were trying to. They had to deal with inflation while trying to deal with a recession. This is what happens in these populist cycles. And so, and of course, when they were forced to choose growth because unemployment went to 10, right? Inflation went to 20%. And the Fed
so then my question to you then would be, do you think we are on the start of that next leg up in inflation? Do you think?
I think this is the beginning of the second leg of inflation. Yes,
it is. And then, so then if we had to think about timing, that will then lead to a recession in 2 years, like, if we were to bet on kind of when is the repercussions of that new inflation spike going to happen.
And I don't only have to get the long term right. I got to get the short term right.
I got to tell you
the month by month timing and then the scale and size of the move. I mean, the truth is we've done that to a large extent, and we can't but it's not. It's. I hope people appreciate how difficult it is to get the big picture right.
I'm not going to hold you to it.
Get the time. Well, no, it's okay. We'll do our best. Just appreciate that. This is we're choosing not just direction but path, and choosing path is that. It's kind of next level, and you have to take. Yeah, it's tricky, and you can call it in September, and it can happen in August. The point here is the path. And so I've given you the bigger picture, and I can, I think you've heard me talk about the why. Again, it's populism, it's protectionism, it's things we've talked about for 4 years. People point to Trump. Trump's not the cause; he's the vehicle. He is a marketer. He saw what people want. He's giving it. Well, he's at least
promising it at least.
Definitely speaking to the rusted out cities of Middle America, trying to build a middle class America first. And guess what? He's going to deliver on some level of protectionism. Now we can argue how much is it. How big are the tariffs? Are the tariffs going to happen? How much, closed immigration policy are we going to do versus, what's the scale? Are we deporting people? Probably not, but that's what he said. Are we just not letting people in anymore? There are big variances in outcomes, and we'll see. Part of what will drive that is, the political environment and also the economic environment, right? These are things that will then accelerate and decelerate these broad trends, but the trends are here and they're not going away. And I would argue whether it was Trump or Kamala, these trends would still be in place. The difference between the two is a function of speed and rate of change and general path to get to where we're going. I think when it comes to Trump, that immigration and labor, the immigration and tariff part, which broadly speaks to labor shortage. We've been amidst a labor shortage. We've been amidst labor inflation that's been very sticky. We've managed it here in the U.S. as a function of open immigration, and it's very unpopular. Populist times, the number one boogeyman is immigration, right? Xenophobia is the key. Populism is my job, not your job, my job, right? But the reality is, if we're going to rebuild the middle class here in America, that is incredibly, and in the developed world, that's incredibly expensive, that it's incredibly hard, and you can't reverse 40 years of inequality in 3 years, 5 years, even 10 years without a lot of pain. in terms of growth and expense, profits for companies, and labor inflation. The cheat code or the way to manage that in terms of time, so you don't have really painful outcomes, is through increased immigration. The U.S. is very fortunate to be able to, to manage to have people who want to be here.
But can you not manage it through productivity via AI? Can you not say, I don't want to hire two more people and I don't want to bring in people from abroad. I'm just going to make my company more efficient to work with the same staff, but they all have to use AI so they can do 3 people's work each. Isn't that going to happen?
You could do that, and that is another structural force. You need lower interest rates in order to fund the businesses, right, that need to grow the technological innovation, because these things are not profitable day one, right? And they're not ready. The reason I would argue that AI is, where it is and has grown to the extent it has is because of a long, true for a lot of the technological boom that we've seen, is a long period, 20 plus years of really low interest rates that drove investment over long periods of time, despite not being profitable, right? And that's great. The problem is, we all see the economic growth of like, oh, well, we're growing, the technological growth is happening like X. And we look up and we say, well, it's going to continue like X. But what people don't realize is the economic, the technological growth is like this to a great extent because of how cheap money has been and the ability to focus on long-term outcomes. Now, I'll argue, and again, not many people remember the 70s, but when interest rates go higher, growth investing wasn't a thing. There was no growth. Growth didn't exist in terms of technological growth. You had to be, it was value investing because you had to have the growth that existed in companies who had the cash, who were generating income, who could then reinvest and then.
But isn't that the Mag 7? Like the Mag 7 are
that's part of why Mag 7 has performed as well as it has in this period. And this is generally what happens at the end of these cycles as well, because they're the biggest boats and they've got the cash to fund these things. They have the cash. But again, I want to be clear. A lot of the money that the loans and the debt that these companies have, which have been locked in since 2021 and earlier, at some point that goes away. We're talking about money supply. The money supply is the majority of money. What happens when that you have to reinvest and go get those 5-year loans, not at 1%, but at 6% or 7% or 10% or 15%?
Then it's a whole new ball game.
It's not, you can't continue, and it's not just the rate, it's the supply. There's just not enough money out there to reinvest in long-term outcomes. You have to have a profit that people will know that you can pay back in order for you to get a loan. And so money supply is a bigger issue than people realize in technological growth. And again, I would, AI, it will continue to be deflationary. Technological growth, since the invention of the wheel, is deflationary. We all think like, oh, this time is different. We have been exponentially growing in terms of technological advancement since the beginning of time. That's not going to change. It may change on what it means to be a human or all these other things, right? At some point you reach some point where, but I think if you think that AI is going to be the solution tomorrow or in the next 5 years or 10 years to labor supply issues, I think you got it all. You're putting the cart before the horse. There is a clear, exuberance out there about this. Not because it's like, to be clear, the internet, when it came about, different set of circumstances in terms of money supply, et cetera. But when the internet came about, it was changing the world. There's a reason to be exuberant. Exuberance doesn't happen, without a very clear narrative that is true, like a conviction that this is going to change the world. It changed the world. 92% of internet companies went bankrupt in 2001. 92%. The NASDAQ dropped by 90+%. to be clear. And yes, the internet did cause
It massively
it changed the world, but
it's the way we all do everything. Yeah,
yeah.
it's true. It's true. But you know, Elon's calling for, I think it was by 2040, I believe. I'm not sure if this is the right quote, but I think by 2040, he was saying that there's going to be more robots than there are humans, right? More humanoid robots than there are humans, which is an insane thought, right? Like we're talking about in 15 years, how many people are there in the world? If there's that many humanoid robots, I don't think we're going to have any labor issues. Yeah.
Elon also told us we were going to get a Cybertruck 10 years ago. We just got it. It's going to happen.
Yeah.
Eventually.
Maybe on timing. Maybe on timing, he's not.
I'm not saying he's not, like, these things aren't going to happen. I think it's inevitable.
Yeah.
Progress will continue to happen. There's a lot of questions. You can't change the world overnight. There's all kinds of legal kind of structures. There's all kinds of, who owns what questions about, AI that are already becoming major impediments. I know a lot of people in senior management at companies in AI, and the reality is they're having a hard time trying to get data right and work with companies with AI, regardless of the potential benefits, because the risks and costs are so high. And that's just level one. Never mind the input costs, right, and the increased issues, right, with just providing the picks and shovels necessary, right, in order to the amount of investment necessary to do this. So there's questions, as I said, they're big questions when you start changing things fastly. And at the end of the day, they're going to be real pushback if we're in a populist period, and the focus is on rebuilding the middle class. How do you think the regulatory environment and the political environment is going to be around AI? I mean, like, again, I think people are again exuberant for a reason, but it is exuberance. And it is people are overestimating the speed and profits and forces that come with AI. By the way, it's pretty wild to me that AI has been something we've been talking about. Like not just we, like everybody's been talking about since I was a kid. Like artificial intelligence is not a new concept, and the amount of periods we've gone through where like exuberance around it spikes and then decelerates, like never this big, right? And clearly there's more impact now, and there's real economic,
it's more usable for the average Joe now, right? It's a lot easier to leverage that. Like even I do it. Most people I know kind of do it and use ChatGPT for one thing or another, right? So
I don't want to sound so like negative. I'm not anti. Like it's a secular trend, and it's going to change the world. Picking the winners and losers. Also, I think people are overestimating the speed and the scale of what it's going to do. I also think there's just going to be much more, again, particularly in a populist period, much less money funding it than people expect. We've been amidst a technological, zero interest rate.
That's a really interesting point about the kind of resistance, the regulatory resistance there might be to it.
The combination of regulatory and the lack of money, I think, are big headwinds that people are not thinking.
So I want to close out discussion on gold. So obviously you're mainly trading equities as far as I understand it, but you've been quite vocal about gold recently, right? Talking about it being an inflation hedge. It's performed very well in all scenarios this year, right? It didn't really matter what was going on in inflation or, whether it's geopolitics or whatever was happening, whatever the dollar was doing, gold was just going up in a straight line, right? But it's been quite an orderly move in gold. It hasn't really brought a massive gold vol spike with it. Thoughts around that? Do you still see value?
Said to buy gold in 2020, when we first told people to start buying gold, it was in a downtrend. Oil was trading 120 and everybody was trying to buy kind of industrial commodities. And we said, look, not only is gold, now it seems obvious to everybody, but it was very unloved in 2021. And what we were very clear about is it was not just a incredible opportunity to buy gold on that downtrend, A, but B, it was an incredible opportunity to buy gold calls and gold vol. And vol and every other industrial commodity was through the roof in 2020 because of inflation and because of everything else. And gold vol, particularly calls, were underpriced. The gold skew was flat. It's not the case. The vol has accelerated higher, not most recently in the last year, but relative to where it was in 2021, and particularly in the calls in the area of the curve we've been pounding the table on.
What's that? Is that longer dated calls?
Yes. And the reason we've had such conviction in 2021, and it was a very unpopular opinion, was because if you look at history and if you look at the bigger macro structural trends, the most volatile asset, yet the most profitable asset during these types of periods is gold. Now, volatile and profitable. You got to think about it in that light, right? This is not a straight line. It will not be a straight line, and you will have dramatic pullbacks along the way.
Feels a bit exhausted in the near term to me, to be honest.
And if you don't know how to trade, this is not just in gold, right? Performance of assets is a function of essentially two things. One, the longer term structural realities, the weighing machine, and the short term positioning and voting machine, right? And flows. And the best environment, the best time when you're going to make just money hand over fist, and then we've done this innumerable times in our careers, is when you have conviction in a structural trend, and it is unloved, and everybody hates it. When everybody loves it and they're in a structural trend, that's a tough one.
That's where we are now.
That's where we are now. And your best bet is to take your money off the table
and wait for a dip.
And wait for a dip.
I think that makes sense. Silver was an interesting one because silver suddenly took off and broke levels that it hadn't seen in ages. Everyone looks like they got puffed into silver, and then it's like, oh no, sorry, I went straight back below the level. So that's an interesting one because I do wonder whether there's a big catch-up trade in silver. I know there's a lot of people chanting for that, cheering for that, but
the reason gold and silver and precious metals are so volatile is because the fundamental, it's not about fundamentals per se. It is a store of wealth. It is a currency much more than it is a commodity. It has been a store of wealth for 10,000, 20,000, 30,000 years. This is not like I think it's fair to say it is a store of wealth, right? We don't know that for Bitcoin yet, but maybe Bitcoin is as well. We'll see. But gold is a store of wealth. And
I've never heard what your view is on Bitcoin. I've never heard you haven't. I don't know if you've publicly said your view on.
I have. My view on Bitcoin is very nuanced. Let's finish gold, and let me finish gold, and then I'll tell you about Bitcoin. Bitcoin's a longer story. We'll never come back to gold once we go to Bitcoin. But gold is it is a store of wealth, and we are entering a period of increase, and we've said this for years now, and it's continued to be true, increased geopolitical tension. Populism is defined by protectionism as well. The difference between populism and free market economics is free market economics doesn't care about people. It just cares about inputs. It sees people as inputs. And if you give money to corporations and wealthy individuals and send it to investment, it's going to be a race to the bottom. It's going to be trying to go to wherever the lowest, water will flow to the lowest point. Like whatever the cheapest source of labor is where the market will go. Any input, not just labor, any input. The goal of a business is to make profit. It's not complicated. right? That's what we were doing for 40 years. The Federal Reserve, it has one tool, it's monetary policy. Anytime we had an issue, lower the price of money. And who takes that money? Not people.
No, not people.
Corporations, capital.
That's right.
And so, okay, the second we say people matter again, and the people say, hey, enough is enough, send us the money, the system's broken, and populism becomes the zeitgeist. And by the way, that doesn't change, it's generational. It's not like a whim. When that starts to happen, protectionism is, tariffs are I could have told you we were going to have tariffs 3-4 years ago, or not 3-4 years, but before they started with Trump. Like the second we start going into this, again, he's the symptom. He's not he is the symptom, not the cause. He is the vehicle. He's not the cause. And so at the end of the day, you have protectionism, and that means we go from a world of kumbaya cooperation where we're helping China and India and everywhere else grow, and we're getting benefits as well because our corporations are making more money, yada yada, to a world where we're now not cooperating, we're competing, and so competitive world, that makes people unhappy. And human nature, animal nature is when we're competing, is to fight and to have territory and to compete. That's the world we're in, right? And if you think we're going to go to all of a sudden back to this world where China, U.S. cooperates and we send money to capital, it's not happening. Like the politics, that's not what people want. People want to rebuild the middle class. The system is not fair. It's not just. That's not a fairness.
They want
justice.
to close the inequality gap, right?
Yeah, and that was that's how we borrowed from the future, right? The Fed did not have a mandate on inequality. It had a mandate on price stability and growth. Well, the hack to get both is to make the system more unequal, to send money to the top, which doesn't cause inflation. We did that for 40 years. We borrowed from the future. Now we are trying to fix that system and rebalance. Well, that's not, it was free for 40 years. Now there's a cost. And that cost is inflation, right? We start sending money from the rich to the poor, regardless of GDP, right? That's massively inflationary. So the point here is, as it relates to gold, is when you start to have geopolitical tensions, FX swings, right? People rush into safety in the US dollar, which is what we've seen structurally, which we said. But then you also have, because you have global war and tensions, and other entities are now trying to, as we saw with the BRICS, come together and bring another answer to US dollar, right? People are looking for alternatives. Like the dollar is expensive, things are imbalanced. Where do I get safety? And so gold's the natural place to hide. And gold, by many measures, is incredibly cheap after a 40-year period of underperformance. And so it's likely to be convex. Well, but again, it's going to be volatile because there's no fundamental underpinning per se, right? It can go anywhere, and that's but the flows.
When you've got the likes of China, and Russia like stockpiling it, and they're going to be sitting on the bid to some extent. So that's why buying dips as your kind of default thing is probably sensible, I guess, right?
Absolutely. Yeah. So anyway, that's gold.
Bitcoin.
And again, quickly here, because again, I think there are other people who would probably have a big disagreements, and there's no right answer. I will be clear to Bitcoin. Bitcoin is not only it's not only a potential store of wealth that's akin to gold, right? It is the gold of the dominant political generation, and that's what matters. All that, when you're talking about store of wealth, it's like who believes it's a store of wealth, right?
Yeah, it's perception.
It's perception, and you have to understand Bitcoin's origin, its creation, was a function of populism. It's a belief of a generation, millennials on down, who went through this period of massive Federal Reserve driven inequality, massive Federal Reserve driven technological innovation, and have experienced 20, 30, even 40 years of a system that's increasingly unfair to them, has them living with mom and dad longer at 40% the wealth creation, household formation of baby boomers at this time in the generation. But they also experience that inequality in the context of all they know, which is technological booms, right? Like just massive new shifts in technology, which are also driven by zero interest rates.
Mm-hmm.
If you were to turn to these people and look at 30-year-old out there and say, hey, what are the things, how do you feel? They would say, hey, the system's broken. It doesn't work for me broadly, right? This inequality has got to be fixed. This is what's driving America first, by the way, A. And B, the way to solve it is through technology, because that's all they know. That's their, and the future is AI and technology and everything. Like, we need to find a technological way to make the system more fair.
Mm-hmm.
Yeah, I mean, it's a natural, like, things respond to incentive. They're an invention of that demand. Now, these people have also underperformed, right? This generation has underperformed. And they're looking for convex instruments and ways to catch up. That's what the YOLO trade is. That's what GME is. That's, it's also what Bitcoin is. So it's also adding from this benefit of like this, hey, we're all in. You only live once. We have to catch up. We're all in on this idea, And so the culmination of this generational zeitgeist has driven this incredible rally in this asset, which, if people didn't believe it, it's a Rorschach inkblot test, right? But that's what gold is. And we're entering a period where populism itself is going to drive more volatility and more flows towards safety in terms of a hard asset. So Bitcoin, in the medium term, meaning the next 5-10 years, is millennial on down like gold.
Yes, it's got a lot of it's going to have a lot of demand, basically, right? There's going to be a lot of people who think that is their way out, basically. Right?
Correct. And on top of just being gold, the benefit is it's easy to move money in and out of other countries in a world where we're increasingly having geopolitical tensions and people are trying to move and get safety. And so the flows from China, the flows from, these other countries are massive. And so,
and one of the things, that's a great point. And one of the things holding it back was the argument of maybe regulation being not so friendly.
You didn't let me get to the negatives yet. I completely agree. So that was the reasoning exists. That's like the bull thesis. That's probably the overwhelming thing that's important right now. When we think about, not just this year, but this 5-year plus window, right? The longer term problem with Bitcoin, much like what ended up being a problem for gold, but I think for Bitcoin, it's probably even worse, is the power, like the entities that are powerful in this world are not okay with having that power withdrawn from them. If you think that fairness and justice, which are the root driving reasons why kind of Bitcoin started, is actually what's going to happen in the world, that this world is going to become incredibly fair all of a sudden. Everybody's going to treat each other we're heading to utopia. Like, no, because what happens as people get older is they realize that's not the real world we live in. Your mom and dad always told you as a child, right? Life isn't fair. Life isn't fair. It doesn't exist. There's no such thing as fairness. Something we may strive for that we want, but life is not fair. There's not just. It's not, none of those things. You can strive for it. I'm not saying it's not a good ideal, but that simple reality means at some point, much like Nixon took us off the gold peg, right? At some point, the powers that be say this is a threat to our power.
At some
point, Bitcoin does not have a sponsor. It does not drive its power through any entity or anything. The U.S. dollar has a sponsor. It's the U.S. government. It's backed by the strength and power of the United States and has an incentive to be backed by. So in the long run, Bitcoin will get regulated. It will get, to the extent it threatens the power of institutions.
But at the moment,
undermined. But that's a long ways away.
I would argue that's a long way away, because at the moment, I would argue Trump's pivot towards Bitcoin and crypto, he sees it as like a land grab. He sees it as there's all this innovation and growth that wants to happen. and we're basically not participating in it because we're telling people we don't want crypto. That's stupid, right? If we want growth, innovation in our country, we need to be crypto friendly. So he's realized that. And well, maybe it was, well, that's what he claims, right? It might have just been to win votes. But if
political expediency plays a big role there.
Yeah, but if what he claims is true and he does become more crypto friendly in the near term, that's a massive win for Bitcoin and crypto.
Sure.
But you're right, at some point when it becomes just so mainstream and well adopted, and then there's this thing where, oh, is this a better alternative than the dollar for me to park my value in? That's when it becomes a risk and a threat, basically. But we're far from that, right?
Yeah, I would agree with that.
Yeah. Mate, it has been a brilliant conversation again, as always with you. I really, really enjoyed it. And I appreciate you coming on the show. Not that, I mean, I haven't done one of these in ages. It's not really a show. It's more of a special episode so that you and me could get a catch up. But I really appreciate it. I hope the viewers are going to enjoy it. I'm sure they'll love it, as always. And until next time, my friend. Thanks.
Until next time. Yeah, my pleasure. Thanks for having me, Imran. Look forward to doing it again sometime. If you want.
Me too.